Welcome back to the Professors in Property. David Cloucher and I today are discussing how and when the next property price crash will happen, and we will share with you lots of data. This is as promised in our last video, which I trust you saw our last video. If not, there's a link down below to that video, which was, should I buy now or should I wait until after the crash? Now, David, today's video, we're going to talk about the great property crash of 2021. Yes, 2021 is when I predict the great property crash will happen. And we're going to cover in this video how property price crashes are normally caused, why do we think it will crash in 2021, how confident we are that it will happen, what is different this time around, David, to previous ones? What are the factors at work in quarter 3 and 4 of 2020? And how does the crash normally unfold? And what have the government done this time to try and prevent a price crash? And what effect did it have on the market? So, without further ado, if you agree with us, tell us if you agree by putting your comments down below, because we are going to be a little bit controversial at times, aren't we, David?
Oh, yes.
And our next video is all about why property price crashes are, or why the next price crash is going to be 40%. If you haven't already, hit the subscribe button so that you can get notified when that video comes out.
And I'd like to just say at this point, if I may, that in this video we're just providing general educational information. We're both property investors, Andrew and I. It's not professional, financial, property tax, or indeed medical advice. And as with any asset class, before making any kind of investment decision, before spending any money, always seek professional advice.
And if you like the video, feel free to hit the share button to share it with your friends. You can tag them in, share it on social media, or wherever you feel it's appropriate. So, David, how do property price crashes normally happen? I mean, to me, it's simple. Interest rates, unemployment, supply and demand. How and why do they normally happen? That way, when we understand that, we can then move on to understand where we are in the cycle.
Right, let's start off with the supply and demand thing, because you often hear that quoted, and a lot of people say that. But consider this. If I go down to the greengrocers, or probably nowadays the supermarket, to buy some apples or oranges, I won't even reach into my pocket and get out my change anymore now because of COVID, but I'll get out my plastic card or something and I'll pay. And it will come straight out of either my credit card or my bank account or whatever. When you're buying a house, you can't really do that. You have to put in a mortgage application. Most people do not buy houses with cash. They need to borrow. So I put it to you that perhaps the bank's willingness to lend is the most important factor of all.
Okay. I mean, I would agree with you, but I'd also say it's down to how much inventory is in the marketplace. And if there's a distinct lack of people wanting to sell their property, yet there's quite a number of buyers, that can cause buyers to make offers above the normal market price. The converse also applies in that if your house is on the market and you suspect that prices might be about to fall, then you might reduce your price as a seller by £5,000 or £10,000. The agent who's selling another property down the street from you looks at your price reduction and tells his seller, the chap up the road's just reduced by 10 grand, think you'd better do the same. And what it does is causes a perpetual cycle of downward prices. So that's my sort of, I agree with you, David, but I also put that analysis into it as well.
Yes, that's a good observation, Andrew, because clearly there are factors where the market kind of feeds back into itself, a sort of feedback loop, if you like. Another thing you mentioned was rising interest rates, and they can cause the economy to contract, can't they?
Yeah, well, it will cause it to stall because if the cost of borrowing goes up, people don't really want to borrow. I remember the days of 15.9% bank base rates back in around 1992-ish. It was very expensive mortgages, but at the moment we're at 0.05% base rate, which basically doesn't really give anywhere for rates to fall. So, given that interest rates are so low, are we predicting that they're going to suddenly start to skyrocket, David?
I certainly hope not, because I remember those times, and they were very painful indeed for both of us. I guess the 40-year average of interest rates going up to the credit crunch anyway was 8%. I guess that's been skewed a bit by these abnormally low rates that we've had subsequent to that. But if the government even jacked up the interest rates to 5 or 6%, not only would a lot of property investors struggle in today's market, but I think the economy would take a nosedive. So I think we're probably safe for the next few years, I would say at least.
So, if one of the triggers to a property price crash is rising interest rates, and we're suggesting that the government, as part of its monetary policy, will not raise interest rates, I mean, they might tweak around, and if anything, they might go negative, is reports I've been reading, negative interest rates. How could we be looking at a price crash? Are there other factors in there? I mean, we've apparently entered the largest fall in GDP of over 20% on record, and we are supposedly in a recession because we've had 2 quarters of economic contraction, but they're predicting 7 or 8% expansion in GDP this particular quarter. So are we in an economic recession? Is there unemployment, or what's going on?
That's a very interesting one, actually, Andrew. And it's a swings and roundabouts kind of thing, really. And pandemics are so unprecedented that I didn't really have a chance to study the last one, which was in 1918. Even my dad wasn't born then. So it's very difficult to know how these things are going to kind of pan out. But this time we had a recession, not because of fundamentals, but because we were all in lockdown. We were all staying home, and on that basis, you can't really do your ski tour holiday business or something, or many other things as well. Your restaurant isn't going to be exactly thriving as well when there are no customers. However, some companies will have gone to the wall because of this, and so there are going to be people who've lost their jobs because of that. Some firms won't have had a comfortable 3 months worth of money. Some big firms even, which we've seen. And then this business of furloughing people and keeping them at home on full pay. I wouldn't mind betting that a lot of the big employers, since March probably, have been looking at these people who've been sitting at home and saying, what do they actually do in our organisation? So I think we're going to see even more redundancies than we've seen already once furlough comes to an end.
So what we're saying is we've seen a number of businesses go to the wall. We've had Debenhams, Laura Ashley, but I'd describe them as zombie businesses to some extent. They should have gone a long time ago. They've been artificially keeping themselves alive by bully boy tactics of CVAs, which is where they restructure their debt load by renegotiating typically landlord rents. So that's one bit of it, but we've been seeing employers like Costa Coffee sacking staff. We've been seeing Marks and Spencer's, John Lewis, Boots. I mean, we're talking tens of thousands of people being made unemployed. On the flip side of it, there is good news, isn't there, David?
Yes, we've got firms actually creating employment in the retail sector as well. We've got Tesco expanding, haven't we? We've got Lidl who are employing several thousand more people. And others.
So what we're saying is there is unemployment, but it's a structural change to the marketplace caused by a pandemic, and that's going to cause certain things to change. I mean, we've talked about shops. If we looked at offices, lots of offices are predicted to not return, and surveys of chief executives and finance directors have indicated that they see their biggest budget cuts being in their property budgets because they're aiming to have more staff work from home. Now, it's really quite interesting because I was reading a report yesterday by PricewaterhouseCoopers, PwC, and they were saying as a result of home working, they expect that to have more damage on the economy than COVID because they see that as shrinking the economy by 1% of GDP. Because if people are not going to the office, they don't go out for their lunches, they don't browse the shops at the lunchtime, and they're not spending as much. And they've surveyed a very large cohort of people, and that cohort basically said they'd spent less looking through their records, considerably less by home working opposed to office working. So could that cause the property price crash?
Well, these things feed into each other, don't they? And by the jobs that will inevitably be lost at petrol forecourts, at railway stations, and so forth, as some transport contracts, these people are not going to purchase things at the other places that would have propped up the jobs of those who are their customers. So it does tend to be a sort of bit of a vicious circle, a bit of a spiral, downward spiral.
Let me ask the question then. If it's interest rates is not likely to cause it, unemployment will cause a property price crash a little bit, because if people have got less money to spend because they've lost the job, they can't afford the rent, therefore landlords suffer with arrears. If they're a mortgage owner, they suffer because they can't afford the mortgage. This year we've had a situation where the government have permitted mortgage holders to have mortgage deferrals. Now, that's potentially given people a financial cushion, but I mean, what's bank lending like? I mean, are the banks lending more? Are they credit scoring people harder? Are the loan to values going up? Interest rates competitive? I mean, where's that side of things? Because that has an impact.
Yes, sorry. The banks always, in a sense, take a conservative view on these things, and they're trying to sort of look ahead, aren't they? They're trying to look 6 months or a year down the line to where they think things will go. Because, for example, when you buy your standard just property that you live in, and you're having a loan to value, well, that money that you put in, whether it's 15% or 20% or whatever, that de-risks things for the bank, because if the price of that property falls 20%, the bank's stake is safe if they should later have to repossess and sell the asset. So the banks will be covering themselves, but they do err on the side of caution. So if they see the market heading the wrong way, I think that they will make it harder, and there'll be more hoops for people to jump through in order to get mortgages, which will obviously feed back into the market. And then the attitude of regulators factors into that as well.
Okay, so effectively bank lending is contracting a little bit, which could cause the supply chain to slow down. Now, we get property price speculators, and they tend to drive prices up in a market. And we're looking at various graphs of data here, and those graphs are showing the price to earnings ratio, which is the salary versus the price of the house, the affordability matrix, growing at an exponential rate over the last few years. Now, in sort of London, the price earnings ratio is sort of 10 to 15 times salary. which most banks, I mean, when I took my first mortgage, it was 2.5 times. So that's making it incredibly expensive as prices. And when that price to earnings disparity happens, surely there's got to be a crash at that point, David.
It definitely puts a downward pressure on markets. And something that I've seen recently as well, looking at Rightmove and other such websites, is the increase of, in particular in the context of new builds, of shared ownership schemes. And these shared ownerships tended to be something like 50-50. Now in some of these properties, you get to own a quarter. Now, this has a significant, if you're a property owner and you brought this as your home, this has a significant impact some years down the line when you want to trade up. Because if traditionally you'd sell the old property and you'd have enough money from the equity from the release from the sale of that to trade up and get something a bit bigger. But if you only own a quarter of that equity, then it means the gap between your present property and the next one is growing at a rate that would make it very, very difficult for you to trade up. Hence, the market would freeze.
Okay, well, I mean, what we're effectively suggesting is there's a number of factors, and it's a bit of a mixed bag at the moment. I mean, would you say that property prices have appreciated over the last 10, 15 years? I mean, 2008 was our last big price crash. And the fundamentals are looking different to what they were then. I mean, in 2008, that was caused by a bank balance sheet crash, by banks speculating, writing collateralized debt orders, which was basically where they would bundle a load of mortgages together and sell it from one bank to another bank to another bank to a pension fund at ever increasing prices, not actually looking at the strength of the underlying asset. So, do you think we're headed that way based on what we've discussed there?
Well, every property price crash has different cause, and a lot has happened to stop that particular thing from happening. But other causes come into play. And the thing we've got now, I suppose, is when there's rising unemployment. I mean, so yeah, coming back to 2008, there's a great movie with Brad Pitt in it called The Big Short, which explains that in a bit more detail. But basically, it's a slice and dice, and you're putting subprime or sort of delinquent, lower end mortgages, a bit of one of those in, and quite a lot of those in with a few really good ones, and then you're getting Moody's to rate it all AAA. So investors are pitching in, and then the banks were playing a bit of a game of pass the hot potato, weren't they? Really, and the euphoria about this got so heated that by the end, some of the banks who themselves had devised and originated this product, these kinds of product for the derivatives, for fear of losing out, they were buying them back in themselves.
Yeah, well, they were outlawed back 2009-10. So that isn't happening this time. So, I mean, David and I have discussed quite a few things, some of them controversial. If you agree, drop a comment in the box below. If you disagree, drop a comment in the box below. Either way, tell us what you think, and tell us if you think there's other factors we should be including and putting in a future video. Thank you for staying with us during this video. In our next video, we will talk about why the property market crash will happen in 2021. So it's thank you from me, Andrew Roberts, and
thank you from me, David Clouter.